Ryman Hospitality offers forecast RevPAR growth of 7% compared to its competitors' 6%. It offers a current dividend yield of 4.2% compared to 2.3%, and a price to FFO ratio of 12.9 compared to 15.7 for its competition. Ryman offers better growth prospects, superior dividend yield, and is cheaper than its competition. We are initiating coverage of RHP with a buy rating and a $70 price target.
Good evening. Based in Nashville, Tennessee, Ryman Hospitality Properties is a hotel, resort, entertainment, and media company that operates as a real estate investment trust.
My name is Nate Newcomb, and these are my colleagues, William Gilmore, Cody Fincher, Gray Finney, and Lauren Vandermark, and we represent Belmont University in this year's CFA Institute Research Challenge.
Our $70 price target represents 15.7% upside, excluding dividends from the April 10th closing price of $60.52. This expected upside in 2015 will be driven by increases in both room rates and occupancy in the markets in which Ryman operates.
Additionally, Ryman's above REIT peer dividend of $2.60 in 2015 results in a total upside of 19.9%. This upside is substantial enough for us to rate Ryman as a buy and suggest that investors take a long position in the stock.
Ryman operates within the REIT hotel-motel industry of the financial services sector. This industry represents a complex competitive environment, so we will briefly go over the nature of Ryman's competitive position as well as its business operations.
The combination of large hotels and substantial meeting space, Ryman is well positioned to appeal to customers within the $260 billion group hospitality segment. In addition to its formidable group business, Ryman's revenues are supplemented by transient guests representing 28% of room nights.
Ryman's heritage landmarks, comprising its operating attractions segment, continue to provide an additional revenue stream to the company outside of its hospitality business.
With recent investments such as the expansion of its namesake Ryman Auditorium, the company continues to reap the benefits from its operating attractions segment, and we see no reason for things to cool off in the red-hot Nashville market. With 9% compound annual growth over the last 4 years, the operating attractions segment will bolster earnings as Ryman continues to discover new ways to leverage its unique portfolio.
Each of Ryman's Gaylord hotel properties is operated by Marriott Corporation, a leader within the hospitality industry.
Compared to the largest hotels in its 4 markets, Ryman offers an average of 60% more meeting space per hotel room. Additionally, the ancillary revenues, which are generated by groups and conventions, comprise 59% of 2013 total RevPAR.
Ryman is well served by its group focus because even during economic downturns, its ability to collect attrition fees insulates it from the revenue decreases faced by its more transient-focused peers. As noted in 2009, when occupancy rates fell to 64%, Ryman was able to collect record-high cancellation fees. Relative to its peers, Ryman is also less reliant on room rate increases due to the fact it collects a larger portion of revenue from out-of-room spending.
While Ryman has outperformed its peers over the past year, it still shows strong potential for continued earnings growth. Industry-wide strength in both occupancy as well as room rates, along with Ryman's positioning in attractive markets, will continue to provide the catalyst for future bottom-line growth.
The competitive environment is complex. Large international hotel C-corps may only have one comparable property in their portfolio, but they offer increased brand recognition and rewards networks. In addition, they may operate hotels owned by others under franchise agreements, presenting both opportunities and threats.
REITs, meanwhile, may focus on a specific property type or geographic region. While no other competitor offers the same unique market mix as Ryman, the company does compete with other large hotel C-corps with resort-style properties or other REITs with group capabilities.
Ryman occupies a clearly defined niche within the hospitality REIT industry. Each of its hotel properties is located in the top 10 convention destination market, allowing Ryman to take advantage of the high demand for travel and conventions in these attractive locations. Additionally, roughly 40% of Ryman's revenue is generated in the Nashville, Tennessee market, which in 2014 saw an increase of 15% in hotel room average daily rate, which was the largest increase of any U.S. city.
Ryman has many factors working in its favor. With the size of its properties and amenities offered, its everything under one roof value proposition creates significant barrier to entry for its competition. Not only can Ryman host multiple contracts simultaneously and larger groups as competitors, but its operating attraction segment adds operational diversification to its portfolio.
While large contracts provide cash flow predictability, Ryman's property size leaves it dependent on forward group bookings, which does not afford it the opportunity to raise room rates when deemed economically appropriate. Another concern could be that Ryman operates in only 4 markets with 1 core property per market. As such, any operational disruption or any diminution in market attractiveness could significantly unsettle Ryman's financial positioning.
Next, we'd like to delve briefly into our expectations for Ryman's future financial performance. In order to arrive at a revenue growth rate that we feel best encapsulates the conditions that Ryman will face in the near future, we utilize data from Smith Travel Research in the 4 cities in which Ryman owns property. In each city, we took the 3-year average breakdown of group and transient RevPAR. We then took the 3-year average breakdown for room nights booked for group and transient customers. Once we had the growth rate for each hotel, we weighted each property by its percentage of rooms to Ryman's total rooms to get a revenue growth rate of 7%.
In addition to our proprietary growth rate, we made several other key assumptions to round out our forecasted financial statements. First, we assumed that the company's operating expenses would remain stable as a historical percentage of sales. We also assumed that the company's depreciation expense of $112 million would remain stable, as over the forecasted period, Ryman will make no new property acquisitions. Third, we assumed that Ryman would continue to deplete its $17 million in tax credits as it has done over the past several years. And finally, the company's dividend will continue to grow at 10% per year based upon its 2015 dividend of $2.60.
Our price target of $70 is, to arrive at a revenue estimate that we believe, we considered 2 discounted cash flow models to arrive at our price target. However, to arrive at our actual price target, we considered a funds from operations and adjusted funds from operations multiple model valuations, the data from which we believe proves superior for the purposes of valuing a REIT.
We chose to utilize models based on funds from operations and adjusted funds from operations due to the fact that they have historically proven to be the best measures of REIT operating performance. In addition, these measures do not rely on historical cost accounting, removing any standards and consistencies.
Conversely, the free cash flow models we found to rely too heavily on such potentially inaccurate historical accounting standards, particularly in the way hotel properties are valued. While individual companies' calculations may vary slightly, funds from operation can be calculated by taking net income and adding back depreciation and amortization to arrive at a number that better encapsulates total cash flows. AFFO takes us a step further with further add-backs for other non-cash items. Both of these metrics aim to provide a standard by which REITs can be measured and compared.
Our FFO price target of $73.42 is based on a 15.7 times projected multiple. This is in line with the industry average. Assuming a constant level of 51 million shares outstanding, we project 2015 basic FFO per share to be $4.68, which gives us our price target when the multiple is applied.
Our AFFO price target of $66.45 is based upon a 2015 projected multiple of 17.7 times. This is again in line with the industry average. Assuming that Ryman's 51 million shares outstanding remains constant, this results in an AFFO per share of $3.76.
Our price target of $70 lies roughly equidistant between our FFO and AFFO model valuation targets.
We'd now like to discuss a few of the risk factors that investors should be aware of when considering investing in Ryman. Ryman's status as a REIT requires to pay at least 90% of its taxable income out to shareholders in the form of dividends. This means that virtually any material acquisitions will have to be financed externally.
With only 4 properties and nearly 8,000 rooms between them, Ryman is subject to the whims of both group booking as well as broad and local economic conditions.
Federal income tax laws prevent REITs from operating hotels. Therefore, Ryman must employ an independent eligible contractor and as such is reliant on Marriott to manage day-to-day operations and bookings.
Ryman has an unrivaled portfolio of assets located in 4 booming U.S. cities, growth that outpaces its peers, and a dividend that matches that performance. We believe that RHP represents a substantial opportunity for investors, and we hope that you don't sleep on Ryman.
This concludes our presentation. We will now be happy to answer any questions you may have.